appreciate that. I don't know if Rentech really has much of a ring to it, though. And I can talk about this with this panel for the next 3 or 4 hours. So I'm happy to go over if that's what we want to do. Before we get started, well, I have an esteemed panel up here. This is really what we're doing here. It's a roundtable discussion. We're going to be getting into some of the topics that have been discussed today and sort of take some of the major topics and delve into them in a little bit more depth with my esteemed expert panel here. So before we get started, why don't we just go down the tables here and just give a quick couple of sentence introduction of yourself.
Sure. Sorry.
Yeah, you need to bring it a bit closer.
Adam Gowler with Crossfire Bank, and again, a member of the Board of Governors of LPI.
Nat Hoops, Executive Director at the Marketplace Lending Association, representing 19 companies, many of which are in the room.
Mark Franson from Chapman & Cutler in Chicago.
I'm Joanne Barefoot. I'm CEO of Barefoot Innovation Group. I host the podcast show Barefoot Innovation. I'm co-founder of Hummingbird Reg Tech, and I'm also an advisor to a firm, and Max Levchin wanted to be here today, and so he and I have talked, so I'll try to share some of his thinking.
Matt Burton, CEO and co-founder of Orchard Platform, and Max is one of my investors, and I wish he was here as well.
Colin Derrick, Chief Compliance Officer, General Counsel, Rocket Loans, and on the Board of Governors of OLBI.
Okay, so I want this to be sort of an interactive discussion, but I want to, so feel free, everyone should feel free to just dive in at any time. So since we just had Congressman Meeks up here, it's the first time I've actually seen him speak. It was fantastic, I thought, very enthusiastic. I think it really helps to have somebody like that in Congress who can be somewhat of a cheerleader for our industry. But I wanted just to start off with just some discussion about reality, and we have this bill that. It's officially called the Protecting Consumers Access to Credit Act of 2017, introduced by Congressman Meeks and McHenry. And I know that this has been, we've talked about the Madden fix several times today. I know, Nat, you wrote an op-ed just last week about this bill and why it's very important. Now there's lots of consumer groups that are against this bill. I'd like to maybe Nat, we can start with you and just say, you talk to staffers on the Hill. I mean, what are the realistic prospects of getting something done here?
Well, thank you. Easy question. I wouldn't want to handicap a percentage, but I will say that sometimes these efforts take a number of years or a couple of Congresses for them to germinate. Last Congress, this was a bill introduced by McHenry. I believe it had no Democratic co-sponsors and did not have a Senate companion bill. This year we have a bipartisan bill in the House. Senators Warner and Toomey, Senator Warner being a Democrat, Toomey being a Republican, are leading it in the Senate. And so you have, I would say, a lot of momentum in Congress behind clarifying this issue, and you have a nice consortium of fintech firms, small business trade associations, and community banks that are active in working on doing the type of persuasion that Congressman Meeks was referring to. It just simply takes to get anything the attention that it needs to get through Congress. And so I think we are at a point now where members of the key committees, House Financial Services and Banking, are aware of the issue. Democrats and Republicans are jointly agreeing that a fix is needed. That in and of itself is a major step forward from where we were in 2016. Now, I think to get it signed into law is going to take another push. It's going to take a push up at leadership. Senator Schumer, McConnell, there's going to have to be an agreement that this provision can ride along with something else. It's unlikely that there's going to be dedicated time on the Senate floor for this type of standalone provision. And so We stand, only a little bit into this Congress. This is a 2-year Congress. 2018 elections, are not until next November. And so it would not have to be reintroduced until January of 2019. So we have, I think, some runway between now and then to continue to get sponsors, Democrat and Republican, and try to move it forward.
Mm-hmm. So then what are the, I guess maybe we could, Colin, you could maybe talk about some of the things, with OLPI. What is OLPI doing to help educate the people on the Hill about the importance of this particular bill?
So events like this and getting the experts in the room like this panel to really, it's great that there is a consensus on both sides that realize, this was, Madden was a poorly decided case, and there's, both sides of the aisle recognize that and kind of really giving them policymakers the information about the impact of a bad decision and the impact of kind of turning your back on, case law that's been around for 100 years of the valid when made doctrine. And it's one of those where when it initially comes out, there's a lot of articles that give a broad overview of what the impact is, but then as it percolates and there's studies that come out that say, this was such a impactful, poor decision that it's hurting credit in the Second Circuit, and bringing that information, like this is the data that bad law creates, less access to credit, and so doing programs like this, trying to do more white papers and educating the actual data and the facts, so that groups like the MLA can kind of put that forward to say, like, this is what this is the data. This is why we need a fix from both sides, because both sides will always say that they want to improve access to credit.
Mm-hmm.
And I think it's also just emphasizing access to responsible credit, right? I mean, I think the consumer group concerns are that the partnerships between banks and fintech firms could be used for abusive products, and I think it's incumbent on the industry to, A, not issue abusive products, B, show that their products are helping borrowers get out of debt at rates that are more affordable than the credit card offers or other products that are legal in the states that are impacted by the Madden decision. And then, finally, it's making sure that the positive vision of fintech that was outlined by Congressman Meeks, that person can get the most affordable, possible product that he or she should possibly qualify for. That's the vision. It's not just access to credit, it's access to the best possible credit they can get.
Mm-hmm. Mm-hmm.
Peter, let me just sort of take a little bit of perhaps a contrarian view, because remember that Madden really is a case about preemption and what happens when that loan goes to a non-bank or an assignee. And we need the Madden fix. That will put a lot of stability into the capital markets and into the folks who purchase these things, but I don't think that's the end of the story. It's maybe hopefully answers the preemption question and gives us clarity there, but we've also got then, and it's a different issue, the true lender issue. Because even if we get past the point of a loan is valid when it's made, I think we will find others saying, well, who then is really making the loan? Is it really a bank? Is it really the platform behind the bank? And we've seen of bits and pieces of this around the edges, in the case out of West Virginia and the CFPB and the Native American tribe out in California. But I think that the battleground will shift even if we get that Madden fix to a true lender emphasis.
Mm-hmm. Mm-hmm.
I think one of the other things that I've seen effective in my previous life when I was in the online advertising space is making the case through data. And I think one of the difficult pieces is all of the data in our industry and the benefits that we're bringing to consumers and small businesses is very, very fragmented, and you can't walk into a congressman's office and just like Congressman Mick's saying, say, this is how many people in your district over the past 3 years got access to credit, whether it was real estate or consumer or small business loans, and this is what the positive benefits to your district, because that changes the conversation a lot. When you're walking in and you don't have any data to back that up, it becomes more difficult to be able to win people on your side, because at Orchard, I mean, we look at a lot of this data, and you know, it pretty much in every case, you can see that when the credit gets expanded into these communities, it's definitely good for, you know, the borrowers. You see FICO scores go up, you're seeing better access in areas where a lot of bank branches have closed, but it's been tough to this point to get all the data to be able to make those cases.
You know, we mentioned earlier that part of the education process is certainly the data, but part of the process is also educating regulators on the distinction between different business models. Nat made the point that a lot of times there's this view that payday lending and marketplace lending are really the same thing. And I think on our panel earlier, we made the distinction that it's very important to educate regulators on the different models, because the data is great, and that will show, you know, how access to credit really helps and how bad law can prevent access to credit. But I think that in many of their minds, we haven't done a good job of distinguishing between the facts of what irresponsible credit and actually responsible credit is.
Yeah, and I think on the true lender issue, just to liven up the panel by being disagreeable, I'll only say that I think addressing the Madden issue can go a long way towards solving the true lender issue, because I think Cross River Bank or Web Bank are going to be able to prove that they are banks, and they're going to be able to prove to regulators that those banks are subject to the laws of either being an ILC or a New Jersey bank, and that those banks come with the powers to export interest rates. Ultimately, if you really are a bank, you know, you're going to have bank powers. And so I think once the issue around loan transfers is resolved, I think it's going to go a long way towards addressing the sort of the uncertainty that's come up between the partnerships of banks and fintech firms.
All true. We just have to convince the plaintiffs bar of that.
Okay. Well, let's move on. I want to move on to sort of to the regulators and the OCC. We had obviously the acting head of the OCC here earlier today, but I actually want to talk. Joanne, you said in the panel that you were on earlier that you said one of the problems is that the regulators don't know what their guidance should be, and you know they have to allow experimentation before they can really issue guidelines. How are they going to do that when we don't really have a mechanism in place for that right now?
Yeah, we did talk on the earlier panel about the movement towards so-called sandboxes and reg labs and greenhouses for the regulators to use. I'm talking with all the U.S. regulators pretty much, not all of the 50 states maybe, but a bunch of them, and all the ones in Washington, and regulators around the world as well. And I think there really is a movement underway of regulators realizing that they're going to need new models that can keep up with the pace of this change. You know, under our current regulatory models, it takes 2 or 3 years to go from start to finish with a new regulation initiative. And the main thing they're missing is the data. You know, they can't answer the question of how these new innovations, including marketplace lending and others as well, are actually going to impact consumers. You know, how safe are the models? How safe are including the algorithms and alternative use of data? How are they marketed? How do you distinguish the predatory from the non-predatory? And I think they need room for test beds. And I think more and more of them are realizing that. And we heard that from Keith Norika today, that the OCC is planning pilot programs. And I think I think we'll just see that picking up. And then the trick is going to be to get them to share with each other instead of each doing it individually. And I think there's talk of that underway too.
Yeah, I feel like we've got, I mean, one of the things that struck me is I think someone said today that there are 24 countries in the world right now with some sort of regulatory sandbags. That was you, right?
Yeah. If you look there's research out, if you Google Aspen study on Reg Labs. The Aspen Institute did a study with funding from the Omidyar Network, And they've got 24, and really there are more. There's more like 30 or more that are actively thinking about this. I think I mentioned this morning, I was on the phone this morning with Abu Dhabi, which has a reg lab, and they're talking about building what they called a digital city that's going to be a platform where banks, fintechs, investors, and regulators all can come together and have a flexible way of sharing new ideas and connecting up with each other and everything. You know, it's just fresh thinking compared to what we've been used to in the past.
Yeah, and that to me, I mean, I sometimes think this country takes for granted the leadership position in finances. Obviously, it's the biggest economy in the world. It won't be within, I don't know, 10, 20 years, but it is right now. And I think there's been, I mean, for someone who's not born in this country and somewhat of an outsider, I see it as, you know, we need to lift our game if we want to stay the really at the leader in innovation. I mean, I go to China and I see China is the leader in financial innovation in the world today. I think I would argue that there's more going on in China. Now, obviously, very different regulatory structure, and it's very light touch until it isn't, but it's very much a country where the entrepreneurship that's happening there, it's fascinating. And I know, Matt, you spend a bit of time in China, and you talk to a lot of different countries. I mean, do you feel that where the innovation is being stifled here when you look at some of the stuff that's happening in other countries?
I guess, you know, I'd want to make sure that we come down on the side of sustainable innovation, though, right? So our, you know, I think the benefit that the way a lot of this industry has evolved in partnership with a bank, an originating bank, or banks as buyers of loans, I think has been really healthy in the sense that, you know, rather than sort of, you know, wildly operate and then go figure out the compliance later, right from the beginning, a lot of these platforms have partnered with regulated institutions that have pushed compliance requirements down on them, and that means that these I think companies, from a standpoint of making sure the government understands and approves of what they do, that's something that's in the DNA of these companies. And I think some of the contrasts that you've seen in the other countries where, yes, they may be ahead of us in allowing experimentation, and we may need to learn from them in that area. I wouldn't necessarily say that the lack of kind of a regulated regime, the way a fintech firm gets from a partnership with a bank, here in the United States has been 100% positive, because I think that those types of partnerships have helped this industry avoid some of the pitfalls that you might have seen in places like China.
Oh yeah, for sure. I mean, there's no doubt, and lots of individual investors have lost a lot of money in China in different you know, let's just say fraud that has taken place there. So I'm not saying that China's really the model that we want to copy, but my point really was the fact that innovation is happening at a faster rate there. Now, I think we can certainly, I think the US isn't that far behind, but you know, I just want to go back to my previous question. I want to ask Matt.
Oh, sorry.
That's okay. About, you know,
I also go to China.
Yes, I know.
Taiwan, at least.
Well, I know we were talking at lunch about, you know, talking with Brazil and the different, and I know you've been to China many times. What are you hearing from the platforms in those other countries?
Well, I think we had a great panel on this as well. This whole trend is a global trend. It's accelerating faster outside of the U.S. than it is here in the U.S. because the need is larger. And so that was a core piece of what we were discussing in the earlier panel. I really enjoy traveling abroad as a sneak peek to the future. What's been amazing in going to China is you go back 2 years ago even, and largely, you know, they were kind of on par with the U.S. in terms of the ability to apply online for a loan and get access to it and invest. And then 2 years later, you know, I'm the only one using cash as I walk around. Everything has gone to mobile payments. Their growth rates are 10x ours. They're now in a phase where they're building out the wealth management portion of their fintech ecosystem. They've almost kind of moved past lending on that side. And the other interesting thing about it is that I see more internationally than in the US is the large technology or internet companies are playing a huge role in financial services and driving that growth, while in the US we have not seen, pick your company, Facebook, Google, Amazon, really dive into financial services. And so that's a big change, and what you see is in those cases, when they move into financial services, they can increase the adoption curve much, much faster than we can here in the US, as all of these new companies have to go acquire all the customers one by one.
Could I just say, I think the point is very well taken, that this is moving faster outside the U.S. because it is more needed and because there's less fully developed regulatory and technology infrastructure. And I also would say I think our U.S. regulators do a great job and are, they have the hardest job in the whole thing.
Yeah.
But that said, an advantage that other countries have over us is that they're viewing fintech as a national competitive issue, and they also are viewing it as a growth issue, economic growth engine throughout the developing world, and certainly in China. And by the way, Martin Champeza back here was on the earlier panel. We should plug his book as well, because he spent time in China understanding exactly how they're doing this. We were in the same program at Harvard. But anyway, I think that our mandate for our regulators here doesn't even include a competition mandate, which is has been one of the drivers in other countries.
Right, and particularly the UK, I'm sure. I mean, that's what you're
Especially
referring
in the
to.
UK.
Yeah, where,
And like in the UK, what's been amazing is not only have you seen the government put forward a sandbox, the regulations have come in, they've even been funding some of the loans, but they've also been helping a lot of the platforms interact with potential sovereign wealth funds and international investors who want to invest in the UK. So from the competitive angle, they really view it as something that they will need to help these companies get up to the global scale quickly, which is something that we don't have here at all in the US.
right. Okay, so let's move on to another topic here. So I want to talk a little bit about financial inclusion. I mean, we had William Isaac this morning. He painted a pretty stark picture, said 60% of Americans cannot get credit from the banking system. There's certainly, people feel like everyone wants to expand access to credit. But then I know in one of the panels this afternoon, it was Joe Toms that said that, that they're seeing in their business, oftentimes when they're doing the debt settlement part of their business, 3-4 loans from online lending platforms that are coming on board, where there's been a stacking kind of mentality. And so, how do we go from expanding access to credit when, the credit that we're doing today, that we're giving today, is in some ways it's too lax as it is. It seems like in some ways. So maybe. I mean, I don't know, maybe Colin, do you want to tackle this at your platform? I mean, how are you handling that sort of the tension between expanding access to credit and making sure that you're doing good loans?
So it's a balance of, it's constantly looking at our credit model and constantly running data to see where there are weaknesses. And so that's one of the pluses of being an online platform, is that you have this very large digital footprint of different classes of borrowers. And then we're a new platform, so we're just getting into the 2 years bit of data to kind of really see. So we haven't had that much loans going to 36 months, like we haven't had any. But we're able to track that data and kind of see, where are some areas where, there's borrowers that are performing exceptionally well and they don't fit into the easy DTI FICO bucket. Like, just based on that, they shouldn't be performing as well as they are. So how can we delve deeper? And that's where you get into machine learning and you get into some of the overall analytics. And that's what's exciting about we've talked a lot about the other panels, the CFPB no action letter, of creating that bridge of understanding of, this is data, this is what the data is showing us, this is what we want to try. They work with, Upstart, and they come up with a plan to go forward and kind of track and test to make sure there's no ECOA issues. And the idea of other federal agencies kind of joining that process of, they are the experts, they're the financial experts, and this is, they're the regulators that understand the financial systems and their guidance and their guidebooks day in and day out. So they're the ones best equipped to test something that's not familiar to them. And then, if it doesn't fit neatly into their guidelines and guidebooks, they can, waive implementation or something, or just say, yeah, let's try this together, and then we'll test it and see, because you don't know the impact. You can sit back and pontificate about what the impact is going to be on consumers based on past experience, but past experience isn't really up to speed with all the fintech. So you have to let some things out there, especially if our end goal is to get access to credit and not harm consumers, and that's everybody's goal here. So if you get the right people in the room to try to reach that goal, and then you slowly, roll it out, and there's not a foot fault and a gotcha, and here's a consent order, like, it's great that you tried that, but, now with our metrics, we think you had a fair lending violation, so don't try anything again. So we need that cooperation, and it does seem from both the congressmen and some of the talks today, like, there is some consensus over that. So I like the idea that Congressman Meeks said, like, with some of the provisions in the Choice Act, like grabbing just provisions that, people can on both sides get around that will be a fix, and pushing those forward, because it'll get us pretty far, and then we can catch up. And the fear with some of China too is, as it grows, and there is a lot of control that could come in. So if there is a foot fault there, it's not like the CFPB does. They see a foot fault and then they go after one company, and there's a big sanction and everyone gets scared and regroups. With the fear is there's a foot fault and they're like, all right, we're done with this industry. Let's try something else. So that's why I kind of there are some pluses to our system of kind of slowly rolling it out.
Mm-hmm.
I think it's one thing it's really exciting to be in the fintech space, because it's not staying static in any way. And so the problems that Peter just brought up are real. Loan stacking is real. It exists. There's not good, sometimes backup servicers in place. There's not good transparency for the regulators or access to the data. But we also live in a really exciting space where right adjacent to us, you have effectively the blockchain, which is the only database that has never had any downtime and has never been hacked. So a really easy implementation of that at scale is going to be in our industry to solve all of these problems. And so what I think is exciting, and why I'm very optimistic about the future of the space, is there's all these other areas of fintech that are having these massive discoveries that is going to be able to be used by our industry over time to solve really, really tricky problems that were impossible to solve before. And so I think that this is going to really open up new business models.
I mean, also, just on the sort of amount of credit available, too much, not enough, I really think you should look at the overall size of the consumer credit market. If we're talking about consumer or small business credit market, I mean, these are massive, massive, massive markets. And I don't think anybody in this room thinks that all the people, before any of the companies that are in this room existed, that all the people in the consumer credit market were in a product that was particularly great for them necessarily. So you also have to look at it in the context of, if people are swapping out, for instance, revolving credit, where they weren't able to sort of extricate themselves ever and pay down a debt, and they're swapping it out at a lower interest rate and they're debt-free in 2 years or 3 years, yes, they may have borrowed. Maybe they took out multiple loans, but those loans were used for a purpose that ultimately was positive for their financial health, where they had never been in a particularly positive point before, and their FICO score went up and so forth. So I think it's very important to look at this industry and how much credit is being made available at what price, and look at it in the context of how much credit is outstanding, and look at it in the context of what credit products people are in. I think ultimately the promise of this industry is to deliver a lot of people the best possible product that they can qualify for. And
I think a lot of that is around data. And I mean, the Upstart no action letter has been talked in just about every session today, has been talked about, and it's not really about alternative data. It's more like alternative credit models. But I would like, with alternative data, you can increase the credit box with more data. And there is so much data out there now on individuals, and what I would like to, I'd like to sort of have a discussion about what responsible use of alternative data, how much can we actually use, and there's certain alternative data that is not really alternative. Let's face it, like a person's cell phone bill or rent bill. That's not alternative data. It's called alternative data because the credit bureaus haven't been keeping tabs on it. But there's also true alternative data out there. But maybe Mark, you could give your perspective on this as far as where, how far can we go when, keeping in mind all the fair lending laws that we have on the books. If we need to be able to use this data if we want to expand access to credit. And what are some of your thoughts on how far we can go there?
It's a very, very good question, Mark, because it illustrates the example of where regulation can sometimes constrain what we have the ability to do. And certainly you're correct, Peter, that some of the laws that are on our book to protect personal information and, in essence, prohibit sharing without either consent or notice and the ability to opt out of that, whether it's with even affiliates within the same organization or outside of the organization, becomes a much more difficult task to do. But of course what we're trying to do is balance both the needs for the business and the need to access additional credit products with also the privacy of that personal information, which has also been a cornerstone of a lot of our consumer protection laws. There are not, at this point in time, a lot of easy answers to those particular questions. It may be that we have to think of actually maybe alternative credit bureaus that put your telephone bills and all these other things in where it can be then accessed in a new and different way. So I think we have to be thinking in that broader concept too about that.
If I could just add, I think that one of the issues has been is that historically anything outside of FICO has been viewed as alternative. So at some point, when the data actually exists, to the point made earlier, FICO may actually account for some of those data points. The issue has been is that a lot of these data points are too new or too untested to warrant inclusion in such a scoring model. So over time, not only over time over at scale, and that's also important, scale is important, right? On the platform level, on the industry level, but also the credit cycle. So once you get to scale, once you have data, everyone's still going to want to see those loans and those attributes go through a credit cycle and see how they've been predicted. So it's going to take time. I do think at some point, Mark, whether you're right, that there'll be another scoring model that, aside from the three major bureaus, that will be used, perhaps, maybe even probably. But I think that the three criteria for that will be scale, time, I think just uniformity of use. I think that those are all important.
And of course, you got the fair lending aspect sort of layered on top of some of that, because the deeper we go in the data, and there's also been some studies out, for instance, some people have been gone after by their regulators because they were using data such as, this person is driving a van, and so that therefore means that they probably have children, and therefore they're married, and being marital status is one of the protected classes under fair lending. So the deeper we go, the more of these kinds of issues we're going to be facing too.
Mm-hmm. Could I add, if Max was here, I think he would say the following, because I heard him say it to a room full of regulators a month ago, and I agree with it. The single best thing we could do for financial inclusion would be to create the regulatory framework within which you can use payment data. bank account data that shows whether people are paying their bills or not, and whether they're, what their income and outflows are. And a lot of financial companies are already using that one way or another, but the disparate impact issues under fair lending are not clear. I know for a fact there are a huge number of players that are afraid to use it for lending, even though they're using it for fraud and AML. And as you say, Peter, it's about the data, and it's also about the new models. And I think the industry needs to be ready for the emergence of concern and interest in AI and machine learning as a broader issue. The GAO has a report coming out this fall on AI. How are we going to decide this? What is enough data? What are appropriate data? How do you decide whether these models are fair, whether they're using proxy type factors that may correlate with protected classes? And there's a trade-off between predictiveness and explainability in AI. So the most predictive models are the hardest to explain. So we have this emergence in the regulators thinking of explainable AI. There's a lot of conversation around computational integrity, computational ethics. And this industry is going to be in the middle of figuring out what are the fair and auditable and defensible standards that should be used in all of this.
Someone mentioned cell phones. Maybe you think about the millennial population. I mean, studies show that millennials aren't homeowners today, right? There's an increasing trend towards millennials being renters. So why is it that rent is not included in one of the FICO attributes?
It's crazy.
It's crazy. But again, until you have broad adoption, until there's been enough research and studies and time through a credit cycle to show it's predictive, you won't have adoption. So I think when we start thinking about, access to credit, we need to start thinking about what are those demographics showing us that make us think about how we can change things for the better. And I think rent and cell phone bills are the first two I'd start with.
And I think people are going to really want regulators to permit responsible experimentation, because if you look at probably one of the most unpopular financial products available today, it's a government student loan, right? It's not price sensitive. It has takes no account really for your credit profile. It's pretty much a one size fits all product, and people if that's what they get, they're grateful for it. And for the most part, it sort of wiped out the private student loan market. But really, people are pretty angry at their government for providing them with 7 and 8%. Student loans for graduate school debt or whatever, and burdening them with that legacy with no opportunity for a better product, and they're refinancing out of that product as fast as they possibly can. So I think the history shows that people don't really like one size fits all pricing in financial services. They want to get the best possible rate and the lowest cost product they can possibly qualify for, and I think it's up to industry to figure out how to deliver them that without using data in any way, shape, or form that discriminates.
And I just want to bring up something that's somewhat sacrilegious in this room, but I'd like to get a bit of a debate going, because I was having a discussion earlier about this the 36% limit that we have. It's not really a federal statute, or it's in the Military Act or whatever, but it's not. But people use it as if it is a line. It's not a line in the sand. It's a wall that we're not supposed to go over. And I remember there was Doug Lebda, the CEO of LendingTree, was speaking at Lendit like 2.5 years ago, and he said he believes that every single consumer should be able to get a loan if he can just price it at the appropriate rate. Now, some people that rate is going to be 300%. Some people, it's going to be obviously less. But the reality is, why can't we have a system that prices above 36%? And all this under the state usury laws are all over the place, and they're all significantly lower than that. But I'd like to just throw it out there that why isn't 50%? If we could expand, if we go up to 50%, you could suddenly add millions, possibly tens of millions of people into the credit box that is currently, they currently don't have. They're doing these short-term, other alternatives. But whereas if you could do a 50% loan, that would be something that is that is a better product. You talk about better products. You know, a 50% loan is way better than going to a check cashing place or going to a payday loan store.
If you think about that idea, which might be radical as viewed by some, but you have to evaluate people's ability to repay those loans. So I think to your point, for convenience, does it make sense for an emergency for someone who would qualify only for a loan at 100% to get a 100% loan? Perhaps, but I think the issue, at least from a regulatory standpoint, would be unless you can demonstrate that those borrowers have a chance to actually pay back that loan, they wouldn't consider that safe and sound.
Mm-hmm.
So I think the tension you'll have is that, yeah, availability of credit is important, not the expense of the potential of people getting into a debt cycle that they never get out of. So, and that's also been the line. The reason why 36% has sort of been used as an arbitrary number is that somewhere along those lines you start inferring or FICO scores or certain credit profiles, and I think that beyond that, at least the line's been drawn where here's where the payday space starts and the traditional space ends.
Mm-hmm.
And I think that's an important distinction, like we talked about education before, and until we have a way to assess people's ability to repay from a credit standpoint for loans above that, I think that line will have to be arbitrarily taken.
I think one of the other big issues is that somehow fees are not calculated into the interest rate, and so you see all these crazy products where the fee, if you added the fee in, the effective APR would be 1,000%, right? And even some banking products are like this, like an overdraft fee where you barely go over, and then you get dinged $25. Like, it's very easy to have those APRs be 1,000% when you look at it as a short-term loan. And so there doesn't seem to be any framework for looking at the total cost of the product, not just the APR that's on it, because something that has a 10% origination fee up front but then has a very low rate, might have a high cost to it, to the end consumer at the end. And so I think this is another one of these problems that not only is there the 36 kind of arbitrary, it seems, limit, you also don't really calculate in these other pieces that affect the cost.
It's a balance. If you look at the non-consumer space, look at the business lending space, you have products like merchant cash advance. I have a friend who's a CEO of a merchant cash advance company, and he tells me some of the terms that people take, and they seem ludicrous, but when you really think about it, what are those businesses doing? They would shut down without that product, some of them at least. So you have to balance between making credit available and responsible credit, and I definitely hear both sides of the argument.
Okay, so maybe Joanne, I'd like to get your perspective on this. If we don't, how are we going to go from 60% not ineligible for a bank-like product? How are we going to go from 60% down to 40%? And obviously, it's not going to ever go to zero. Not even going to, that's or 10 or even 20%. But 60 to 40 sounds doable. But you're still talking a massive jump. How do we get there?
I think I might have said on your panel last year, and I believe it even more a year later, that the technology change underway actually has the ability to solve all the problems that consumers have in their financial lives, apart from not having enough money. That's a separate problem. But even if you're poor, you have a financial life. You got money coming in and going out. You probably need to borrow. You would like to save. And we need a model that works for everyone, and the technology can provide all of it. It's driving down the cost of providing financial services, as online lending shows. Mobile delivery is reaching, the World Bank has a goal of having every adult in the world have a so-called bank account by 2020. They're not going to hit that, but they're coming pretty close. In the 2020s, everybody's going to have so-called banking in their phone, everybody in the world. And so, we're driving down the costs, we're improving the consumer's ability to get information, compare information, shop, manage our own bad habits. We've got voice assistants coming. How many of you have Alexa? Do we all love Alexa? I know I do. The easiness of being helped by these smart assistants. So anyway, I don't want to divert, but that's the answer. These issues have been deadlocked for our whole lives between people who want more regulation or less regulation, and they assume that if you have less regulation and lower costs, it's going to harm people. The technology is solving for this. We can have better outcomes at lower prices if you can convince the players through data, empirical information, that consumers will really benefit. I have worked for the U.S. Senate and for the, and I've been a bank regulator. You know, when industries come in and say our product is really great for the consumer, everybody's programmed to be skeptical of that, as they should. But this industry has the opportunity to create that narrative that we really can make it both cheaper, comparatively cheaper, and more accurate in the underwriting, and get these loans to people in new ways. The 36%, I agree it's arbitrary. I think it's wrong. I totally agree with what you're saying. And a bigger point that you're making is our whole disclosure model has failed. We've been trying for a half century since the Truth in Lending Act to solve consumers' problems by doing mandatory disclosures. I'm writing a book on this, and I'm writing a paper for Harvard. I've just been researching the data on the failure of disclosure. I mean, it's just unbelievable. So, but people get information in their cell phone, you know? Why are we giving them stacks of paper at all? Let's let them search in new ways. So I don't know if I'm answering your question, but the other thing is, the philosophical thing at the heart of it is, how much should we protect people from themselves as a government? If we think they're making a bad decision, should the government step in? And that's a tough one to answer.
Right, but I totally agree. I think we are going to have the data. Imagine, you said, when everyone's got some sort of financial product on their phone, you're suddenly going to be able to, get that data. And there are some companies today just doing fantastic work where they underwrite the customer, whether they're in Kenya or in Tanzania or in Mongolia. They are underwriting purely based on the data on their phone, and they're doing it in like 5 seconds. And that's the sort of thing, that's where I see like the developing world is leading the way. Now they have different regulatory structures in these countries, but the regulators, when you talk to like Jeff Stewart, the CEO or the chairman of Lendo, and regulators are begging them to come in because they have the technology that can actually create like in one shot an expanded access that they didn't have before. Now I feel like what we get, it's going to take a while for us in this country, I think, to really embrace it. But I feel like the technology, we're almost there. I'm personally very excited about it because I feel like over the next, really, I think 3 years, we will find massive change when it comes to the ability to have this data that we can use to underwrite. And we're seeing it now. Where it starts is in fraud prevention. I mean, fraud prevention, is a piece where we have, we can use more data in fraud prevention. We can't, you can't use it to underwrite, but you can use it to do fraud. And I feel like that's changing a lot. But anyway, we are getting towards the end of our time, and I want to just go around and say, right, when we gather here in a year's time, what do we, I was going to say, what do we hope will have changed? That's probably the wrong question. What do we actually think will have changed in our industry when it comes to the regulatory piece? And let's, maybe Nat, do you want to take a stab at it?
In a year's time, we'll pass the Madden fix. Fintech firms will have been welcomed into the banking system under new charters. Now,
you're an optimist.
Yes. No. I think in a year's time, we're going to all benefit from having the administration get a little bit more on its feet. I would hope with personnel. There are people that are sitting at the Treasury Department now that have only been there a very short time. Those people are working on a series of reports. There's going to be one coming out on fintech, just like the other reports that were mentioned earlier, that I think will start to grapple with some of the issues that we're discussing today. So I think that you're going to see Washington smarter than it was a year before, and I hope that we will have also passed the Madden bill.
Okay. Anyone else want to take a stab at what do you expect will happen in the next?
Well, I
12 months?
realize that, we're in Washington and everything revolves around Washington, but there are also 50 states out there too.
Right.
And I think one of the things that we've started to see a trend in this regard, and that's regardless of what happens at the federal level, the states are active, they're becoming more active, more interaction is going to happen with online lending at the state level. So I think we'll see renewed focus there as well.
Okay. Well, I've given Connor, he's got about 14 minutes left to wrap it all up. Okay. Okay. Well, anyway, thank you very much, panelists. I appreciate it.
Thanks, Peter.
Thank you all. Peter and Adam and Nat and Mark and Joanne and Matt and Colin. I think I got them all.